If you've got $20,000 sitting somewhere right now, there are 3 mistakes you could make with it. And I'd bet money you're already halfway into one of them. Mistake 1, you leave it parked in a savings account because it feels safe. Mistake 2, you throw it at whatever stock everyone's talking about this week. Mistake 3, you do absolutely nothing because you're waiting to feel ready. And another year quietly disappears. Any one of these can set you back a decade. So, for the next few minutes, I'm going to walk you through the exact framework I used with my own first $20,000. No jargon, no fluff, just the actual steps in order. By the end, you'll know precisely what to do with your money starting today. Let's get into it. Why investing isn't optional. Let's keep this part short because most people already know they should invest. They just haven't been given a real reason that sticks. Here's the real reason. If you never invest, you are the only thing generating income in your life. Your money just sits there, doing nothing, while you're the one showing up every day to earn it. Investing flips that. Your money starts working alongside you, but there's a second, sneakier reason, and it's the one most people ignore. Inflation. Money that just sits still isn't neutral. It's quietly losing value every single year. Think about something as simple as your regular coffee order. A few years ago, it might have cost you $2.50. Today, that same drink is probably closer to $4. Nothing about the coffee changed. Your money just buys less of it now. Stretch that across everything you spend money on. Rent, groceries, bills, and the effect compounds. Something that cost $10,000 a decade ago could easily cost $14,000 or more today. So, if your $20,000 just sits in a checking account earning almost nothing, it isn't standing still. It's going backward. Investing solves both problems in one move. It grows your money and it protects the value you already have. That's the why. Now let's get into the part most people never actually get taught properly. How your money grows in the first place. How your money actually grows. There are exactly 2 mechanisms at play here, and understanding both changes how you think about every dollar you invest. The first is ownership. When you buy a stock, you're not just buying a ticker symbol, you're buying a tiny sliver of an actual, real business. Say you invest in a company that makes phones. If that company sells more phones, opens more stores, and becomes more profitable, the entire business becomes worth more. Your tiny slice of that business becomes worth more too. You didn't do anything else. The business grew, and your ownership grew with it. The second is compound interest, sometimes called the 8th wonder of the world, and for good reason. Compound interest means you don't just earn returns on the money you originally put in. You also earn returns on the returns you've already made. Your gains start generating their own gains. That sounds abstract, so let's put real numbers on it. Say you invest $1,000 a month and earn an average return of 8% a year. Reaching your first $100,000 might take you around 7 years. That feels slow. But here's where it gets interesting. Your second $100,000 doesn't take another 7 years. It takes about 4. Why? Because now you're earning 8%, not just on your new contributions, but on that entire first $100,000 as well. Your third $100,000 might only take 3 years. And the milestones after that arrive faster and faster, because you're now earning returns on an increasingly massive base. By the time you're closing in on your first million, you could add another $100,000 in as little as a single year. That's why they call it a snowball. It doesn't roll at a constant speed. It starts slow and accelerates dramatically over time. And this is exactly why your first $20,000 matters so much more than it looks like it should. It's not really $20,000. It's the seed of every single milestone that comes after it. This is also why people who start early, even with tiny amounts, end up miles ahead of people who wait for the perfect moment. With compounding, Time in the game matters far more than perfect timing. Before you open any investment account, there are two things you need to handle first. Skip these, and you're investing with one hand tied behind your back. First, kill high-interest debt. If you're carrying a credit card balance at 20% plus interest, that comes before investing, full stop. Paying off a 20% interest debt is, in effect, a guaranteed 20% return on your money. No stock market on earth can promise you that consistently. Investing while that debt sits there is like trying to fill a bucket that has a hole in the bottom. You're working against yourself. Second, build your emergency fund. A good baseline is 3 months of living expenses. If it's just you, push that to 6 months if you've got a partner or dependents relying on you. If you want to be extra cautious, 9 months isn't unreasonable. This money shouldn't be invested, it should sit somewhere safe and easily accessible, ideally in an account that still earns some interest. Once those two are handled, there's one more thing to check before you open a brokerage account. Does your employer match retirement contributions? If yes, contribute enough to get the full match. That's free money, a guaranteed return you will never find anywhere else, and it gives your investing a genuine head start. After that, look into any tax-advantaged investment account available to you. Whether that's a 401k, an IRA, or whatever your country's equivalent is, your money compounds faster when you're not losing a chunk of it to taxes every year. Foundation done. Now, let's talk about where the money actually goes. What should you actually invest in? This is the question I get asked more than any other. Stocks or real estate? Let's be fair to both. Real estate absolutely can be a great investment. I'm not here to talk anyone out of it. But one reason I lean toward talking about the stock market more is simple. The barrier to entry is dramatically lower. Most modern investment platforms let you start with less money than you'd spend on groceries. Saving for a property deposit, on the other hand, can take years. And that's before you factor in maintenance costs, taxes, and the very real responsibilities that come with being a landlord. Stocks and index funds tend to be more passive, more predictable, and far more accessible for someone just starting out. That doesn't mean real estate is wrong for you. If you've got the time, capital, and interest, it can absolutely work. But for a beginner with their first $20,000, the stock market is usually the more practical starting point. Now, here's where a lot of new investors go wrong the moment they decide to actually put money in. They look at whatever performed best over the last few years and buy that. This feels intuitive, but it's one of the most common and costly mistakes you can make. History makes this painfully clear. In 2010, one phone brand dominated the market with nearly 37% global market share. By 2020, just 10 years later, that same company's share had collapsed to under 1%, and its stock price had fallen by roughly 70%. Anyone who bought in because they're clearly winning, watch that logic fall apart in real time. Zoom out further, and the pattern repeats. Go back about 40 years, and the biggest companies in the world were dominated by industrial giants and oil companies. Go back just 20 years, and the landscape looks completely different again. Different leaders, different industries entirely. Today's biggest companies weren't even the biggest names 2 decades ago. In fact, out of the largest companies from the early 2000s, only a small handful still hold that position today. The takeaway: chasing what performed well in the past is not a strategy. It's a coin flip dressed up as logic. And as a beginner, putting your money into individual companies concentrates your risk in a dangerous way. Your entire outcome now depends on one business making the right decisions over and over indefinitely. It's the oldest warning there is, all your eggs, one basket, one stumble, and everything cracks at once. So, what should a beginner actually buy? For most people, the simplest and lowest effort answer is an index fund. It's not about being lucky, and it's not about becoming a market expert. A single index fund can hold shares in thousands of companies spread across dozens of countries. one purchase gives you instant diversification. You're no longer betting on one business succeeding. You're betting on the broader economy continuing to grow over time, which historically has been a far safer bet. This is the set it and forget it approach. Automate a monthly contribution into a diversified index fund and let compounding do the heavy lifting over the years. It's not exciting. It's not a story you'll tell at a dinner party, but it works quietly in the background for decades. The mistakes that trip up almost every new investor. The biggest risk in investing was never the market itself, it's your own behavior. Here are the 3 patterns that derail more beginners than anything else. Mistake 1. Procrastination. So many people have money sitting in savings, too scared to move it. The excuses sound reasonable on the surface. I don't fully understand this yet, or I'll start once I've learned more, or I just want someone to tell me I'm doing this right. I understand that instinct completely. Nobody wants to make a costly mistake with money they worked hard for. But while you're waiting to feel 100% ready, time keeps moving and you're quietly missing out on years of potential growth. You don't need the perfect investment on day one. You need to start small, stay consistent, and learn as you go. Look at the long-term performance of a broad market index like the S&P 500. Investors who stayed invested for any rolling 20-year period have almost never lost money, even accounting for the Great Depression, the dot-com crash, and the 2008 financial crisis. Time in the market beats timing the market almost every time. Mistake 2. Chasing trends. This one is almost a rite of passage for new investors, and it happens to nearly everyone at some point. You learn the basics of investing, start feeling confident, and suddenly every hot stock or trending coin looks like the obvious next big opportunity. Before you know it, you're buying into a company you heard about for the first time yesterday. This isn't really your fault. It's a well-documented psychological pattern. Once you know a little about a topic, your confidence tends to outpace your actual understanding. You feel like an expert right at the point where you've barely scratched the surface. That overconfidence is exactly what leads people to jump into whatever's trending, convinced they've spotted the next big winner, only to watch the value evaporate almost as soon as they buy in. If you genuinely want to buy individual stocks for fun or to learn, that's fine. Just keep it to a small, deliberate slice of your overall portfolio. Treat it as money you can afford to lose while learning, not your core strategy. Mistake 3. Panic selling during downturns. This is arguably the most expensive habit an investor can develop. When markets drop, the instinct is to pull your money out to stop the bleeding. But selling during a downturn does the opposite of protecting you. It locks in the loss permanently. The best investors do the exact opposite. They stay calm and often invest more while prices are lower. What makes that possible isn't bravery. It's having a clear, well-understood plan going in, so a downturn doesn't feel like a crisis. It just feels like a normal part of the process.